How do businesses calculate the amount of profit or loss made during a period? I'm Thomas Harwood and welcome to The Accounting Student, where we create free and short videos so that you can learn about accounting. Today's video is looking at the income statement, including its purpose and the trading account section of the income statement. Many businesses are started with the intention to make a profit, and in many cases businesses do make a profit. However, some unfortunately make a loss. The calculation of profits and losses is arguably the most crucial objective of the accounting role within a business. This is why we have the income statement. In our previous video on what is the trial balance is a useful tool in grouping all the revenues and expenditures together. The account balances recorded in the trial balance are used to create the final accounts, which includes the income statement. The income statement, which can also be known as a trading and profit and loss account, shows a summary of the revenue and expenses of a business, and as a result this can establish the level of profit or loss made in a given period. Users of the accounting information like the owners, shareholders, management and employees will be interested to know how the actual profits of a business compare to the profits that they hoped to make. This is where the income statement is helpful to identify what profits or losses were made by the business during a period, and additionally it will help the business and its stakeholders or users of information carry out many tasks, including planning ahead the future period's activities and trading, the capability of acquiring loans from banks and other financial institutions, providing information on the business performance to potential business partners and those who might invest in the future, and also being able to calculate the tax to be paid on the trading profits. The income statement can be broken down simply into two main sections, and they are the trading account and the profit and loss account. In this video we will look at the first part, which is the trading account section. The trading account measures the success of a business's trading activities. In other terms, what was the difference between the cost of buying the stock and the amount which it was selling for. Furthermore, this difference can be identified as gross profit. This can be shown simply in a trading account like this. At the top we have the title as the income statement for ABC Limited for year ending the 31st of December 2017. The title is followed by the total sales for the business during the period. Then we have the opening stock value for the start of the trading period. This is basically all the stock which the business has at the time in which the new trading period begins. We then add the purchases line, which looks at everything that has been bought by the business during the period. This could be materials in order to make products or products that are finished which the business resells. After, we will have the closing stock for the period, which will be all the materials and products still left in the business at the end of the trading period. The closing stock will be taken away from the total of the opening stock and purchases, and this will arrive at the value for the cost of sales. The cost of sales is the cost of goods that have actually been sold during the trading period. This will then be taken away from the sales value, which leads us to the gross profit value for the period. So that was the first part of explaining the income statement, its purpose and the trading account section. If you enjoyed it, press the like button. If you have a question you want answered, leave it in the comments below and we'll try our best to answer it. And if you're not already subscribed, make sure you click the red subscribe button to keep updated with The Accounting Student. Thanks for watching, we'll see you next time.